Opening 30-second script. Iran wants to change the rules of oil settlement by pushing the Chinese yuan. Many people call this the rise of the Petroyuan and the death of the petrodollar. But that is too simple. Oil is not only priced by politics. It is priced by liquidity, trust, convertibility, insurance, shipping, debt markets, and military security. In this video, I will explain why Iran can pressure the dollar system, why China can expand yuan settlement, but why the petrodollar may still remain powerful for another 20 years. When people talk about the Petroyuan versus petrodollar, they often frame it as a simple currency competition. But that interpretation is fundamentally flawed. What we are witnessing is not just a shift in payment preference. It is a deeper restructuring of financial power, geopolitical alignment, and global system architecture. Oil is not just a commodity. It is the bloodstream of the global economy. Every major industrial system, transportation, manufacturing, logistics, ultimately depends on energy. And whoever controls the pricing and settlement currency of oil effectively controls a key gateway of global capital flows. For the past 5 decades, the United States has anchored this system through the petrodollar. By linking oil pricing, financial markets, and military protection, the U.S. created a self-reinforcing ecosystem where dollars are continuously demanded, recycled, and reinvested. Iran's recent push toward yuan-based oil settlement is not simply about convenience. It is a strategic response to financial isolation. Under heavy sanctions, Iran has been partially excluded from the dollar-based system. As a result, it is forced to innovate alternative pathways to sustain its energy exports. This is where the yuan enters the picture. By accepting yuan for oil, Iran is effectively turning energy into a financial bypass mechanism. It reduces exposure to U.S. sanctions and builds a parallel channel for trade. At first glance, this seems like a direct challenge to the petrodollar system. However, there is a critical distinction. Changing the transaction currency is not the same as replacing the system currency. The dollar does not dominate because it is used for payment. It dominates because the entire global infrastructure around oil depends on it. Shipping and logistics contracts, marine insurance markets, derivatives and hedging instruments, foreign exchange liquidity, sovereign debt markets. These layers form what can be described as a financial operating system. Iran can modify how oil is sold, but it cannot independently rebuild the system that supports global energy trade. Therefore, the real question is not whether the yuan can replace the dollar in oil settlement. The real question is, who can build the next global financial operating system, and how long will it take? Iran's push toward yuan-based oil trade is not ideological. It is highly strategic and driven by 3 clear objectives. The first objective is sanctions avoidance. The U.S. dollar system is not neutral. It is embedded with regulatory oversight, surveillance capabilities, and enforcement mechanisms. Through SWIFT, correspondent banking networks, and treasury controls, the United States can monitor and restrict global financial flows. For Iran, this creates a structural vulnerability. As long as oil is traded in dollars, its revenue streams remain exposed to disruption. Moving to yuan-based settlement allows Iran to partially bypass this system and regain control over its financial lifeline. The second objective is market survival. China is currently the largest oil importer in the world, consuming roughly 18 million barrels per day. It is also Iran's most important buyer. In fact, a large majority of Iran's seaborne oil exports are directed toward China. In this context, yuan settlement is not just a political choice, it is an economic necessity. If your primary customer prefers yuan, aligning with that preference ensures continued market access. The third objective is strategic alignment with China. Iran and China have established long-term cooperation frameworks, including energy agreements and infrastructure development initiatives. This creates a structured corridor where energy supply, financial settlement, and geopolitical interests are aligned. This leads to a simple but powerful equation. China provides demand. Iran provides supply. The yuan provides a financial shield. However, this system has limitations. It is fundamentally regional, not global. Iran can sell oil to China using yuan, but that does not give it access to global capital markets, diversified investment opportunities, deep and liquid financial instruments. This creates a critical constraint. Iran is successfully escaping the dollar system, but it is not yet building a scalable alternative system. And that difference defines the limits of the Petroyuan strategy. At first glance, the Petroyuan narrative is extremely compelling. China is the world's largest oil importer. In theory, the largest buyer should have significant influence over how transactions are conducted. If China prefers yuan, then suppliers should logically adapt. This leads to a common assumption: buyer power equals currency power. But this assumption is incomplete. Currency dominance is not determined solely by trade volume. It requires a combination of 3 structural factors: convertibility, the ability to freely exchange the currency; Store of value, the willingness of global actors to hold it. Financial depth, the existence of large liquid markets for investment. The yuan currently satisfies only part of the first condition. While it is increasingly used in trade settlement, it lacks the full convertibility and deep financial ecosystem required for reserve currency status. This is clearly reflected in global data. The yuan accounts for only a small percentage of global cross-border payments, while the US dollar dominates the vast majority. This indicates that even when trade shifts, the underlying financial system remains anchored in dollars. Therefore, the rise of the Petroyuan should be understood as a shift in transaction layer, not a shift in system layer. China can influence how oil is purchased, but it cannot yet redefine global oil pricing benchmarks, Brent, WTI derivatives markets used for hedging, international debt markets, reserve asset allocation. This distinction is critical. The Petroyuan appears powerful because it is visible at the surface level, but the deeper layers of the system, where real financial power resides, remain dominated by the dollar. The strength of the US dollar is often misunderstood. It is not strong because people choose to use it. It is strong because the global system is built in a way that requires it. There are three structural pillars that sustain dollar dominance. The first is liquidity. The dollar is the most accessible and widely traded currency in the world. Governments, corporations, and financial institutions can obtain dollar funding quickly and at scale. This makes it the default medium for large international transactions. The second is safe assets. The U.S. Treasury market, exceeding tens of trillions of dollars, provides a reliable destination for global capital. Oil exporting countries need a place to store and invest their revenues. The U.S. offers unmatched depth and stability in this regard. The third is network effect. Because the entire world uses the dollar, switching away from it becomes extremely costly. Every contract, every financial instrument, and every system integration is already optimized for USD. As a result, the dollar functions as more than a currency. It is a global financial infrastructure layer. In the oil market, this infrastructure includes shipping contracts priced in USD, insurance policies denominated in USD, hedging instruments based on USD benchmarks, trade financing linked to dollar liquidity. To replace the dollar, a competing system must replicate all of these layers simultaneously. That is not a monetary shift. That is a system rebuild challenge. The limitations of the yuan are not about scale. They are about structure. The first constraint is capital controls. China maintains strict regulations on capital movement. This restricts the ability of foreign entities to freely move funds in and out of the country. For global investors and oil exporters, this creates uncertainty and reduces the attractiveness of holding yuan. The second constraint is limited convertibility. A global reserve currency must be freely exchangeable across markets and asset classes. The yuan does not yet meet this standard. This limits its usability beyond bilateral trade agreements. The third constraint is reinvestment flexibility. Oil exporters do not just want to receive payment. They want to deploy that capital into global investments. The U.S. financial system offers a wide range of options: bonds, equities, derivatives, and alternative assets. China's financial system, by comparison, remains relatively closed and less diversified. This leads to a critical conclusion. The yuan is efficient for transactions, but inefficient for capital storage and global allocation. And that is the core difference between a trade currency and a reserve currency. The petrodollar system thrives because it allows capital to circulate globally without friction. The Petroyuan system, at its current stage, cannot replicate that level of fluidity. Many analysts argue that the transition to renewable energy will weaken the petrodollar system. However, this transition is significantly slower than commonly assumed. Global oil demand remains strong, particularly in emerging markets such as India and Southeast Asia. These regions are still heavily dependent on fossil fuels for industrialization and economic growth. Even as renewable energy expands, oil continues to play a critical role in transportation infrastructure, petrochemical production, global logistics networks. This creates a prolonged transition period. At the same time, the petrodollar recycling mechanism continues to operate. Oil exporting countries earn dollars and reinvest those dollars into global financial markets, particularly U.S. assets. This creates a continuous loop that reinforces dollar demand. Breaking this loop requires not just alternative currencies, but alternative financial ecosystems capable of absorbing global capital flows. Currently, no system matches the scale and efficiency of the dollar-based system. This is why many experts believe that the petrodollar system may remain dominant for at least another 2 decades. Iran possesses the ability to disrupt the oil market, but disruption should not be confused with replacement. One of Iran's key strategic advantages is its geographic position near the Strait of Hormuz, a critical choke point through which a significant portion of global oil supply passes. Any instability in this region can create immediate price volatility and supply concerns. However, this type of influence is inherently short-term. Building a new currency system requires long-term credibility, institutional trust, and deep financial integration. Iran does not control global financial markets, reserve asset structures, international legal frameworks. Therefore, its impact remains limited to tactical disruption, not systemic transformation. The future of global finance is unlikely to be a binary outcome, where one currency replaces another. Instead, the system is evolving toward a fragmented, multi-layered structure. In this model, the US dollar remains the core reserve currency. The yuan expands in regional and bilateral trade. Alternative settlement systems emerge in specific corridors. This creates a hybrid environment where multiple currencies coexist, but not equally. The dollar retains dominance in global reserves, high-value transactions, financial markets, while the yuan grows in China-centered trade networks, energy deals with sanctioned or aligned countries. The conclusion is clear. Iran can influence the direction of change, but it cannot redefine the system. And for now, the petrodollar remains the backbone of global energy finance.